Hi everyone and welcome to this new video. This time we'll be comparing two popular ETFs, JP, the JPMorgan Equity Premium Income, and JEPQ, which is JPMorgan Nasdaq Equity Premium Income. So what's JP? JP is the JP Morgan Equity Premium Income. It's an income-focused covered call ETF. It's ideal for conservative investors who are seeking income and moderate growth. This is the case for all covered call ETFs. They are not made for everyone. They are more made for you if you are looking for passive income and you prioritize that income more than growth. So what does the JP does? The manager will invest in a portfolio of stocks that combine three characteristics. So in addition of the covered call strategy, keep that in mind. So they are using covered call strategy on a portfolio that has to be part of the S&P 500. So that portfolio has only stocks that are part of the S&P 500. So we're talking here about only large cap stocks. So you're not investing in anything else. It's just large cap stocks. And the S&P 500 is the 500 largest businesses in the US. So you're having here only really large cap stocks, which is good. Low volatility, so they are picking only stocks that exhibit low volatility. So the portfolio will have only stocks that have a low beta. Beta is a measure of volatility. They will pick also only value stocks. So their analyst team will conduct a fundamental bottom-up approach to select only stocks that are considered undervalued. So what are the advantages of owning JP? The advantages is that they are using call options to which basically increases the yield. So if you look at their portfolio and you try to determine what's the average dividend yield, you will realize that it's only 2 to 3% average. But if you go to Yahoo Finance, you will notice that JP has a dividend yield of 10.03%, which is really high compared to the dividend that I just mentioned. So how they achieve this yield, how they are able to do this distribution, this monthly distribution of 10.03%, it's simply because they apply the covered call strategy. And so that's the first advantage. It has also low volatility because when you invest in JP, you are investing in stocks that are part of the S&P 500. So one can ask, I could just buy the S&P 500 ETF, which usually has a really low fee. But again, if you buy SPY, which is the an ETF that invests in the S&P 500, you are faced with the volatility. You will have less income. As I mentioned, the dividend yield that is not even 2%, but you will also have really high volatility because the S&P 500 it's kind of similar to the market, so you will have a really the same volatility as the market. A beta of 1 means that you have the same volatility of the market. So if you look at SPY, you will notice in Yahoo Finance that the beta is 1. But if you look at JP, JP will find here that the beta is only 0.62, which means that it's lower volatility than the S&P 500. Another positive for JP is the ability to capitalize on high volatility, which translates to increased premium, so high distribution. And also, the investors can save valuable time and effort by avoiding the need to personally write call options on the S&P 500. The fund MER is 0.35% total expense ratio, which is cost effective and quite competitive compared to similar covered call ETFs. And it's also diversified across various sectors, which adds another layer of appeal, spreading risk across different industries. This is the advantages, but if we talk about the drawbacks, the main drawbacks comes from the covered call strategy itself. So the covered call strategy puts a cap on the growth um, by issuing options that kind of put a cap on the growth and seeking more income. So it means that in a powerful bull market, so if the market is going up, because of the option, because of the covered call strategy, JP will underperform the market when it's a bull market. But however, when it's a bear market, usually covered call ETFs, because the way they function, will outperform the market. This is why they kind of became popular lately, because people advertise them as beating the market. But keep in mind, they are beating the market only when it's a bear market or if it's a volatile market, range bound market. But in a bull market, when there is a really like a good performance in terms of the S&P 500, these type of ETFs will underperform the market. So just keep that in mind when using a covered call strategy. So that's the main disadvantage of owning a covered call ETF. So you have to think there, is it a good option for you, or you would like rather have the growth and limited income and high growth versus having a very high income but a lower performance in bull markets in general. So that's what you need to keep in mind. So to recap, the positives here for JP is an attractive yield, lower volatility, ideal for conservative investors and income seekers. And when there is volatility in the market, usually it benefits you because the fund is issuing call options, and call options deliver more premiums when the market is volatile. And of course, it saves you time and money, time and effort in case you are a person who would like to do like option strategies. And the low fees, relatively low fees, 0.35%. Diversification, it's highly diversified. The negative is that in bull market, investors should expect a lower performance than the S&P 500 index. Issuing call options reduces volatility at the expense of high performance in bull markets. So that's for JP. Now for JEPQ, the investment objective is it seeks high distribution yield, same as JP. It focuses on providing investors with a monthly income stream using covered call strategy. And the advantages here you have, the JEPQ is tracking the NASDAQ 100, so it's not the S&P 500. So the NASDAQ, it picks stocks from the NASDAQ, so you will have a portfolio that's large cap tech stocks that are part of the NASDAQ. And using a proprietary selection criteria, the manager would select companies with the highest prospects for growth, seeking the highest adjusted return possible. What this means is just that they pick stocks that they think will have amazing growth prospects, but they have to have low volatility. So they will try to combine these two qualities: low volatility, high growth. Because you could have high growth with high volatility, kind of defeats the purpose. So you always need to have the highest adjusted return possible. Seek the stock that can provide the highest return for the lowest volatility possible. So what are the advantages of JEPQ? It's basically offers similar advantage as to JP. We can go here to the positive, has an attractive yield as we mentioned earlier. It's 11.50% for JEPQ, and it has lower volatility than the Nasdaq 100 ETF. So if you own the Nasdaq 100 ETF and another person owns JEPQ, for sure the volatility of JEPQ will be lower than the person who owns QQQ, for example. And you could notice here the volatility. It's not published because it's it's got a relatively new fund that was created in 2022, but it should be lower than the Nasdaq 100. And it suits conservative investors. Let's say you want to invest in the Nasdaq 100, but you don't have the guts for all these up and down that are typical to tech companies. Then JEPQ is a good option for you because it has that built-in covered call strategy. The volatility of the Nasdaq 100 increases your premium. This is why JEPQ has a higher distribution yield than JP, because it operates in the Nasdaq, and the Nasdaq is much more volatile than the S&P 500. It saves you obviously time and effort. The same with JP. If you yourself wanted to write call options, It offers low fees, 0.35%. It's still considered the very low fee for owning this type of fund. The negative, you have poor performance in case of a bull market. Same as we explained earlier, in a bull market, these type of fund, the covered call ETFs, tend to underperform the market or the tracked index. The strategy of covered call becomes ineffective in an unpredictable market. This means that, like, let's say it will depend on the quality of your manager. So in case of JEPQ, you have to look at the long run. Couple of years from now, then you could evaluate whether the manager was right or wrong in reading the market, because at the end of the day, he's writing call options and he has to understand, read the market, so he could capture the more like the highest premium as possible. So this will all time only will tell us if um, this manager is able to navigate the Nasdaq 100. JPQ is dominated by tech firms, so it's less diversified than JP. As we mentioned, JP is the S&P 500, a bunch of stocks that have low volatility, so it's much more diversified. The S&P 500 has companies from all across industries, whereas JPQ is Nasdaq 100, so it's mostly tech stocks. So you're focused here only on tech firms. Now, for the conclusion, which one should you pick? Ultimately, whether JP or JPQ is a good investment depends on the individual investor preferences, risk tolerance, and market outlook. JP's lower volatility and diversification across sectors could be attractive to those seeking stability and income, while JEPQ focus on a Nasdaq 100 may appeal to tech-focused investors. So if you are into tech companies, you would like to invest in Google and such, then the JEPQ is a better option for you, because you will have exposure to those tech stocks without that volatility that comes with investing in tech companies. It's crucial for investors of obviously to conduct a thorough research before considering one or the other. And even before getting into covered call strategy, you have to ask yourself whether this type of fund is the one for you, because it's not just about distribution yield. You have also to look at the performance. If we compare the performance of for example, JP, since year to date, it's 7.91% total return. For 1 year, it was 11.72%. The average annual return was 11% for 3 years. So it's really a good fund in terms so far. It has a really an amazing performance. For the volatility that we saw earlier, it's really an interesting fund because the volatility is only 0.62. The beta is only 0.62. So what does it mean 0.62? It means that if the market goes by 10% up or down, this fund moves the same way as the market by only 62%. So if the market goes 10% up, this fund tends to go 6% up. The market goes 10% down, this fund goes down 6%. So it's less volatile than the market. The beta is just a historical, so it's not going to happen like 10 plus 10% plus 6, but historically speaking, this is how this fund behaved in the past. So it's an interesting fund in terms of that you have a low beta, but a really decent performance here with an average of 11% per year. So it's really an interesting fund for you to own. Now, if we look at the performance for JEPQ, it's a much relatively new fund. So we have just for the 1 year. You'll notice that it's an amazing performance year to date, 28.46%. And this is due to the fact that they hold only tech companies, and tech companies have done well since the start of the year. Um, so if you want my opinion, like whether so if you are an aggressive investor and you would like really tech stocks for the growth of it, you don't buy JEPQ. Go and buy an ETF that tracks the Nasdaq 100 directly. But if you are conservative and you want to take advantage of those tech stocks and get some monthly income, yes, JEPQ is perfect for you. And in terms of distribution yield, there is no comparison between an index ETF that tracks NASDAQ 100 and JEPQ. It's not even close. The dividend yield on NASDAQ 100 stocks is not even 1%. So yeah, if you are into income, JEPQ is definitely a better option there. Of course, you have to analyze your taxation impact also. Like these two funds, JEPQ and JEPI, both pay a high distribution yield. You have to see like how much taxes you're going to pay on those, depending on your situation. So I hope this comparison between JEPQ and GP helped you. Thank you very much for watching and have a great day.